Silver didn't fall, it was pushed. And the most dangerous part? Most people still think this was a normal market correction. You probably saw the headlines. Silver pulls back. A market correction. Nothing unusual. But here's the problem. Real healthy markets don't behave like this. Prices don't just drop this fast, this cleanly, and this quietly without someone powerful on the other side of that trade. This wasn't a wave of panic selling. It wasn't retail fear. This was precision. This was a targeted strike. While everyday investors were left confused, scratching their heads, someone else was doing the exact opposite. They weren't selling into the panic. No, they were waiting. And when the price finally snapped lower, crashing through key support levels, they stepped in. That's why today matters so much, because what happened to silver isn't telling the story you think it is. And by the end of this video, you will see exactly who caused this move, why it happened, and most importantly, why the smartest money is using this opportunity to buy right now. Most of us are taught that markets are chaotic, driven by emotion, fear, greed, random news headlines, but that's an incomplete and frankly, a misleading picture. Markets are not entirely free. They are heavily influenced, and you need to understand not every trade is equal. Not every participant is playing by the same set of rules. Some traders simply react to the price action. Others create the reaction. Large institutions, the big players, they don't chase price. They position themselves before it moves. They have the access, the liquidity, and the patience that retail traders just don't. So when you see these sudden, sharp drops that happen overnight with absolutely no real change in the underlying fundamentals, that isn't chaos. That is coordination. The price doesn't fall because everyone suddenly decided to sell at the same time. The price falls because liquidity is strategically pulled from the market, immense pressure is applied, and weaker hands are shaken out and forced to sell at a loss. This isn't some wild conspiracy theory. It's about understanding the market structure. And once you understand that structure, moves like silver's recent crash stop looking confusing and start looking completely intentional. Now, silver isn't like stocks. It's not even like gold. The silver market is a small room. And when big players with deep pockets walk into that room, everything moves. Think of it like a very shallow pool. You don't need to do a cannonball to make huge waves. Just stepping in with purpose is enough to splash everyone. That's why silver reacts so quickly and so violently. And that's why it's so much easier to push around compared to other larger markets. But here's the part that most people miss, and it's critical. The vast majority of silver trading isn't for actual physical metal. It's for promises. It's paper claims. It's IOUs stacked on top of more IOUs. Imagine you're selling tickets to a massive concert, but you haven't even started building the stadium yet. As long as only a few people show up at the gate at any one time, the illusion works. But when a wave of pressure hits, even a small push can trigger a panic and expose the entire system. Silver's relatively small market size makes it vulnerable. Its paper-heavy structure makes it controllable. And that combination, that is exactly why it gets targeted. Not because it's fundamentally weak, but because it's so easy to move. There are essentially two different silver markets. One is loud, fast, and digital, with numbers flashing on a screen every second. That's the paper market, the world of futures and derivatives. The other market is quiet. It's slow. It's heavy. That's the physical market, the world of actual coins and bars. And here's the trap that ensnares so many investors. The paper silver market sets the daily price, but it's the physical silver market that determines the ultimate reality. When a massive number of paper contracts are dumped onto the market all at once, the price can fall instantly. But the physical metal, the actual bars in the vaults, doesn't just disappear. In fact, something very strange often happens in these situations. When the paper price drops sharply, physical silver quietly starts leaving the vaults and moving into strong, private hands. Think about that for a second. If silver were suddenly less valuable, as the falling price suggests, why would it be discreetly moving into the possession of the most informed buyers? Why would these buyers step in with conviction precisely when fear is at its absolute peak? It's because the paper market can be pushed around and manipulated, but physical demand doesn't panic. It waits. It's patient. And when the paper price falls much faster than physical availability, a gap begins to form between the paper illusion and the physical reality. This gap is where the opportunity lies. What we witnessed wasn't a vote of no confidence in silver. It was a raid on the paper market, designed to shake out weak holders and allow large players to accumulate physical metal at an artificially low price. They use the paper market as a weapon to get what they really want, the real thing. While the news screams about a silver crash, the underlying story is one of accumulation. Big money is not selling silver. They're buying it from those who are scared by the paper price. This isn't new. This pattern has repeated itself time and time again in the precious metal space. They create the storm, then they calmly collect the wreckage at a discount. They know that, in the long run, you can't print physical silver. The supply is finite, and as industrial and investment demand continues to grow, that physical reality will eventually overwhelm the paper fiction. The price on the screen can be a lie, but a 1-ounce silver coin in your hand is the truth. So, what should you do? The first step is to stop looking at the day-to-day price swings as a measure of silver's true value. See these orchestrated takedowns for what they are, manufactured buying opportunities. The goal of these moves is to generate fear, to make you doubt your position, to make you sell your real assets at a loss. Don't fall for it. Instead, think like the institutions. Use their manufactured panic to your advantage. While others are fearful, this is the time to be strategic. This isn't about timing the absolute bottom, which is impossible. It's about understanding the long-term value and accumulating a real tangible asset when it's being offered at a discount. The disconnect between the paper price and the physical reality won't last forever. At some point, the dam will break, and the true value of physical silver will have to be recognized. The people who will benefit are the ones who understood the game being played and had the courage to act while everyone else was running for the exits. Don't let them push you out of your position. Understand the game and play it to your own advantage. Thanks for watching. If this perspective was helpful, make sure to like and subscribe for more insights. That gap is where repricing starts. And once it starts, it doesn't reverse politely. Here's where the story stops making sense. Because crashes are supposed to come with a reason. Demand weakens, supply floods the market, confidence disappears. But none of that happened here. Industrial demand didn't slow down. Manufacturers didn't cancel orders. Long-term buyers didn't walk away. Nothing changed, except the price. That's the contradiction most people miss. If silver were truly being rejected by the market, you would see it everywhere. Orders would dry up. Dealers would slash premiums. Inventory would pile up. But that didn't happen. Instead, physical silver kept moving. Quietly, steadily, relentlessly. The people who use silver didn't blink. The people who need silver didn't hesitate. Only the paper price collapsed. And when price collapses without demand disappearing, it forces a very uncomfortable question. If this wasn't a reaction to reality, what was it responding to? Because markets don't break logic unless something stronger is acting on them. And the moment you see that disconnect, price down, demand intact, you realize you're not watching fear. You're watching opportunity being created. While the price was falling, the story was already written for you. Silver is overheated. Speculators are exiting. This move is healthy. It sounded reasonable, it felt familiar, but it wasn't accurate, because the narrative focused on price, not behavior, and markets are driven by behavior. Here's what the headlines didn't show you. Now, while analysts were explaining why silver deserved to fall, physical metal was quietly changing hands. Vault inventories didn't surge. Dealer stock didn't pile up. Delivery times didn't shorten, they tightened. And that detail matters more than any chart on television, because if sellers were truly in control, availability would explode. Instead, access became harder. That's the part no one talked about. Not because it wasn't important, but because it didn't fit the story. Mainstream coverage treats silver like a stock ticker. Up is good, down is bad. But silver doesn't behave like equities. It behaves like a supply chain. And supply chains tell the truth long before headlines catch up. So while the narrative said exit, the data said transfer. Metal didn't disappear. It didn't get dumped. It moved from weak hands to strong ones, and when that happens, price often falls first, before it rises violently later. That's the pattern you're watching right now. While price was falling, something very different was happening behind the scenes. There was no panic, no scrambling, no emotional selling, because the players that matter don't react to volatility. They use it. Institutions don't see red candles as danger. They see them as opportunity windows. And during this drop, those windows were wide open. Instead of exiting positions, smart money was stepping in, slowly, methodically, and quietly. Not through headlines, not through hype, through accumulation. They weren't buying because they thought silver was cheap. They were buying because availability mattered more than price. Large players don't chase momentum. They position before it appears. They understand something most retail investors never see. Real risk isn't T price falling. It is not owning supply when it's needed. So while the public focused on charts, institutions focused on access. While retail watched spot price, smart money watched inventory. And when fear peaked, bids appeared, not in size, but in persistence. That's how accumulation actually works. No fireworks, no announcements, just consistent buying while attention is elsewhere. And here's the key difference. They're not trading silver, they're securing it. Because when the market eventually shifts from paper to physical, speed doesn't matter. Position does. By the time price reflects reality, the metal is already spoken for. And the people who move during fear are the ones who benefit when confidence returns. Here's the question most people get wrong. If institutions are positioning, Why aren't they just buying gold? Gold is safer. Gold is bigger. Gold is already respected. And that's exactly why silver is the opportunity. Gold moves when confidence breaks. Silver moves when systems strain. Right now, institutions aren't just hedging risk, they're positioning for imbalance. Silver is dramatically smaller than gold. That means it reacts faster when pressure builds. A relatively small amount of capital can move silver in a way that would barely register in the gold market. And institutions know this. They're not looking for stability, they're looking for asymmetry. Silver offers something gold doesn't right now, undervaluation paired with necessity. Gold is held, silver is used. Silver isn't just a store of value. It's a raw material embedded in modern infrastructure, energy systems, electronics, data centers, defense technology. Gold can sit in a vault forever. Silver gets consumed. And once it's consumed, it doesn't come back easily. The consumption creates a hidden pressure gold doesn't face. On top of that, silver's volatility works for institutions, not against them. Volatility shakes out weak hands. It creates forced selling. It generates entry points. Gold doesn't do that anymore. Silver still does. And then there's the valuation gap. Historically, silver doesn't stay cheap relative to gold forever. When financial stress increases, the gap compresses fast. Institutions understand cycles. They don't buy what's already recognized. They buy what's mispriced. Gold has attention, silver has leverage. That's why capital flows quietly favor silver during accumulation phases, not because it's safer, but because it's more responsive. When the turn comes, silver doesn't whisper, it snaps. And institutions want to be positioned before that sound is heard. This isn't new. That's the most important thing to understand. Every major move silver has ever made started exactly like this. First, price runs too far, too fast, then it collapses. Suddenly, violently, and emotionally, confidence evaporates. Narratives flip overnight. That crash is never random. It's the reset phase. In past cycles, silver didn't break out from strength. It broke out from confusion. The market needed disbelief before it could move higher. You saw this in previous decades, a sharp drop that made people question the trend. Media declaring the move over. Investors stepping aside, waiting for clarity. And while attention drifted elsewhere, accumulation began. Quietly, patiently, methodically. That phase always looks boring, until it isn't. Once supply tightens and selling pressure exhausts itself, silver doesn't climb. It gaps. Price doesn't ask permission. It jumps to where it should have been all along. And when that happens, the people waiting for confirmation never get it. Because confirmation only appears after the move. That's the psychological trap. The market creates fear to justify accumulation, then uses scarcity to justify repricing. Different decades, different headlines, same structure. Right now, you're watching the disbelief stage, the part where people say, I'll wait and see. That is always the moment just before silver reminds everyone how quickly it moves when it decides to. History doesn't repeat, but in silver, it rhymes perfectly. Suppression doesn't fail slowly, it fails all at once. Price holds down, pressure builds, and then control disappears. When that moment comes, silver doesn't ease higher, it reprices. Gaps appear where trades never happened. Liquidity vanishes, offers get pulled, and price jumps to wherever sellers are finally willing to part with metal. That's why these moves feel shocking in hindsight. People don't remember the months of pressure. They remember the days of chaos. This is the part where charts stop being useful, because the move isn't driven by optimism. It's driven by availability. When enough buyers demand real metal and discover there isn't enough at the quoted price, the paper number becomes irrelevant. The market doesn't ask what silver should be worth. It asks where silver can actually be found, and the answer changes quickly. That's why past silver repricings weren't gradual climbs. They were sudden leaps, overnight moves, limit up opens. No pullbacks. By the time the shift is obvious, positioning is already complete. Suppression ends not when people believe, but when metal can no longer be sourced quietly. And when that line is crossed, price doesn't need permission. It simply adjusts to reality. Every cycle has winners and losers, not because one group is smarter, but because one group is earlier. The winners aren't the loudest. They aren't the most confident. They're the most patient. They buy when the narrative feels wrong. They hold when price feels uncomfortable. And they do nothing while others panic. The losers arrive later. They show up. After the move is obvious. After the headlines change. After price confirms what was already happening quietly. They buy enthusiasm instead of positioning. And silver punishes that behavior. Because when silver moves, it doesn't offer second chances. It reprices, then waits. This cycle won't reward excitement. It will reward restraint. It won't reward certainty. It will reward preparation. Right now, the market is asking a simple question. Do you want to be early and uncomfortable, or late and chasing? There's no middle ground in silver, only before and after. This isn't about timing the exact bottom, and it's not about predicting the next headline. It's about understanding the phase you're in. Right now, silver isn't in a breakout phase. It's in a positioning phase. That's where the real decisions are made, long before excitement, long before confirmation, long before comfort. The mistake most people make is treating volatility as a signal to act emotionally. But volatility is often just the cost of entry. The smarter approach is simple. Think in terms of exposure, not prediction. Think in terms of structure, not noise. You don't need silver to move tomorrow. You need it to be scarce later, and everything happening right now points in that direction. This cycle will reward those who stay patient, stay liquid, and stay focused on the long-term imbalance and not the short-term price. No rush, no panic, just clarity. Because when silver finally moves, it won't ask who's ready. It will only move. None of this is advice. It's perspective. The goal isn't to tell you what to buy. It's to help you see what's happening beneath the surface. Markets are complex. Everyone's situation is different. So take this information, verify it, challenge it, and decide what makes sense for you. The opportunity in silver isn't about certainty. It's about awareness. And the people who do well in these cycles aren't the ones who follow opinions. They're the ones who understand structure. Stay curious, stay patient, and stay focused on what's real, not just what's loud. We'll keep watching it. You decide how you position.